In the last 48 hours, one of the most trusted reflexes in global finance started failing in public. 8, pressing into territory last seen in early 2022, while gold hovered near $4,970 an ounce, up roughly 72% from a year earlier. 22%. Those numbers are not supposed to live together when confidence is intact. For decades, the story was simple. When the world gets nervous, money runs to the dollar. When U.S. yields rise, the dollar gets support. When the dollar is steady, gold is less urgent. And yet the tape printed the opposite. Not over months, not over weeks. In 48 hours, the market compressed years of quiet doubt into moves you could measure with a single glance. The part that should make you pause is not the size of the move. It's the direction of the reflex. When the reserve currency weakens at the same time investors are being paid above 4% for U.S. long-term debt, it signals a deeper shift than a routine risk-on, risk-off swing. Here's what most people miss. Correlations break before headlines do. The first crack is not a collapse. It's a hedge that stops hedging. It's a safe haven that doesn't catch fear the way it used to. That is how regime changes begin, quietly, mathematically, and then all at once. Institutions read these correlation breaks because they live inside the machinery of funding, collateral, and settlement. Most people only meet the story when it becomes a clean narrative. By then, the positioning is already in motion. Welcome to Macro Decode, where we follow the plumbing before the front page finds the words. If you want analysis that's calm, specific, and grounded in what the market is actually doing, you're in the right place. Consider subscribing the way you'd keep a wise elder in your circle, someone who doesn't shout, but sees patterns early. And leave a comment with where you're watching from, because this is a global story, and it hits Tokyo, Frankfurt, São Paulo, and Kathmandu differently. Now let's walk through what happened, why it's abnormal, and what usually comes next when the dollar starts behaving less like a neutral utility and more like a tradable risk asset. The immediate trigger was simple on the surface and heavy underneath. On February 10th, 2026, reports circulated that Chinese regulators were urging banks to reduce exposure to U.S. treasuries. That is not a rumor about a single hedge fund trimming duration. That is a signal about balance sheets and policy preference. Around the same time, the phrase "Sell America" began appearing more openly in market commentary. Not as a political slogan, but as a portfolio theme. Reduce concentrated U.S. risk across equities, credit, and duration. If this were the old regime, the dollar would have strengthened on the first whiff of uncertainty. The logic used to be straightforward. When global portfolios de-risk, they sell foreign assets, buy dollars, and pay down dollar liabilities. When funding markets tighten, the world scrambles for dollars because dollars are the language of global collateral. That scramble pushes the dollar higher, even if the U.S. is the source of the stress. It's not love, it's need. But in this episode, the dollar did not behave like the world's oxygen tank. It behaved like something with a price of its own, something that can be discounted when confidence shifts. That is the anomaly. It's a sign that need is being diluted by choice, and that the world is slowly building redundancy. Now layer in the second abnormality, yields. For years, investors were conditioned to think in one direction. Higher yields attract foreign capital supports the currency, and the currency strengthens. But this time, yields were not enough to make the dollar feel safe. The market was effectively saying, yes, you're paying more. That is not a story about one data release. It is a story about trust being repriced. Trust is the invisible premium embedded in reserve currency status. A reserve currency is not just a unit of account. It is a promise that settlement remains reliable, that access remains open, that inflation is managed over time, and that property rights are stable in practice, not just on paper. When that promise is unquestioned, the world accepts lower yields, holds more duration, and uses the currency reflexively. When the promise is questioned, the world demands compensation. And sometimes it demands alternatives. Now take a step back, because this has happened before, and the pattern is clearer when you zoom out. In 1971, the U.S. severed the final link between the dollar and gold, ending convertibility. Result, the world moved into a new era where money became policy, and the 1970s delivered repeated inflation shocks and currency realignments. In 1979 and 1980, confidence in the dollar's purchasing power weakened so sharply that gold surged and policymakers were forced into harsh tightening. Result, a painful reset, a deep recession, and the lesson that reserve status is not a permanent crown. It is a contract renewed every day by market behavior. In 1985, the Plaza Accord showed another side of the dollar's role. Major powers coordinated to weaken the dollar after it became too strong, stressing trade balances and global stability. Result, the dollar declined sharply over subsequent years. The world learned that the dollar's value is never purely free market. It is a market plus policy, and policy can change correlations quickly. In the early 2000s, the US ran large deficits, and the dollar weakened for years while commodities began a long climb. Result: capital rotated toward real assets, and the world diversified slowly. The dollar remained dominant, but the premium declined, and hard assets priced in dollars rose. Then, in 2008, the crisis that many assumed would dethrone the dollar did the opposite. The dollar surged because liabilities were dollar-denominated, and the collateral language was dollar-based. Result: the dollar's safe haven myth hardened into a belief. But the hidden truth was uncomfortable. The dollar's strength came from dependency, not necessarily from admiration. In 2020, another shock repeated the mechanism. Dollar funding tightened, and the Federal Reserve opened swap lines and emergency facilities to prevent a global dollar shortage from freezing credit markets. Result: the dollar system proved powerful, but also fragile. Every emergency tool used is also a reminder that the system can seize up. Now, in 2026, the warning is not that the dollar is ending. The warning is that dependency is being reduced at the margin. And when dependency is reduced, the dollar behaves differently under stress. That's why the institutional movement matters more than the daily chart. Institutions do not need to be certain. They need to be early. And the evidence of institutional behavior is visible if you know where to look. Start with central banks. In 2025, reported central bank gold purchases totaled about 863 tons, and Poland alone added about 102 tons. Those are not speculative allocations. Those are reserved decisions. When a central bank chooses gold, it chooses an asset outside the liability structure of any single government. That decision has a logic: diversify reserves, reduce settlement dependence, reduce sanction risk, and hold something that can function as collateral in extreme scenarios. Now look at reserve composition. 9% by the third quarter of 2025. That is still the largest share by a wide margin. But direction matters. If you run a portfolio, you know the marginal buyer sets the price. If the marginal reserve decision is less dollar, more alternatives, the long-term price of dollar safety adjusts. Here's where it gets interesting. This diversification does not require a coordinated plan to be meaningful. It only requires many actors making similar risk decisions at the same time. One central bank adds gold, another increases non-dollar settlement for a portion of trade, another adjusts the currency mix of its sovereign fund, another reduces duration in treasuries, not because it expects default, but because it expects volatility and wants flexibility. Add those together, and the marginal demand for dollars becomes less automatic. Meanwhile, the US side of the ledger is running a different trend: persistent deficits and large debt issuance. Again, this is not a moral argument, it's arithmetic. A large issuance requires consistent demand. If demand becomes price sensitive, yields rise to clear auctions. Higher yields raise interest expense. Higher interest expense worsens deficits. Worse deficits require more issuance. That loop is manageable if confidence is stable. It becomes unstable if confidence is fragile, because every additional turn of the loop forces the market to ask who the next buyer is. This is the point where the market creates a dislocation. Two signals that should align start pointing in opposite directions. Signal 1 is yield. 22% on the 10-year, the US is paying meaningful nominal compensation. Signal 2 is currency. 8 suggests compensation is not the only input. Signal 3 is gold, near 4,170. Gold suggests the market is pricing a premium for assets outside the system. That three-way contradiction is the dislocation. And dislocations do not last forever. Either the system snaps back to old behavior, or it reprices into a new equilibrium. To see why it can't persist, separate paper markets from physical reality. Paper markets express opinion fast, with leverage. Physical markets express constraint, with logistics. A futures contract can be created instantly. A bar of gold must be mined, refined, shipped, and stored. When official institutions accumulate physical metal, that is not a chart trade. It is a balance sheet decision. When the currency weakens while official actors keep accumulating hard collateral, it tells you what layer of the system is moving. Now let's talk about mechanism, because nothing here requires mystery. It requires only incentives and balance sheets. Think of the global dollar system as the world's payment rails, plus the world's collateral language. Most global trade is invoiced in dollars. Many commodities are priced in dollars. A huge portion of global debt is denominated in dollars. Banks use dollars for funding. Corporations use dollars for hedging. Even when you're not in the US, you are often living inside a dollar ecosystem. That ecosystem has a unique feature. It is both liquid and leveraged. Liquidity makes it efficient. Leverage makes it fragile. When times are calm, leverage is invisible. When times are tense, leverage becomes a forced seller. Forced selling is how markets move faster than logic. Here's a simple analogy. Imagine a city where most buildings are made of the same material, and the fire code assumes that material won't ignite under normal conditions. For decades, that assumption holds. Then the weather changes. The material doesn't instantly burn down the city. But the fire department notices that small fires spread faster than before. That doesn't mean apocalypse. It means the old code was written for old conditions. The city either updates the code or it keeps paying higher insurance premiums and living with higher risk. In finance, updating the code looks like higher hedging costs, higher risk premia, and more diversification. Pricing new insurance looks like higher volatility, stronger bids for real assets, and weaker OA. Automatic demand for the reserve currency. One of the simplest execution paths is through hedging. When foreign investors buy U.S. assets, they often hedge currency risk. If hedging costs rise, the net yield they earn falls, 22% to a hedged foreign buyer if the hedge eats a meaningful share. And when that happens, the buyer either demands higher yields, reduces exposure, or shifts to shorter maturities. Multiply that across large pools of capital, and you can have yields that stay high while the currency weakens, because the buyer is not chasing yield in isolation. The buyer is managing the full package of return, volatility, and currency risk. Another path is through margins and risk limits. When volatility rises, margin requirements rise. When margin requirements rise, leveraged players sell what they can, not what they want. Sometimes they sell dollars to meet obligations elsewhere. Sometimes they sell treasuries to reduce balance sheet usage. Sometimes they sell risk assets and keep cash. The exact path varies, but the common theme is this. When the system reprices risk, it changes what gets sold, and that changes correlations. Now, the players executing this are not mysterious. They are known institutions with known incentives, and their actions often line up through timing rather than through meetings. The Federal Reserve manages the domestic price of money, and by extension, the global availability of dollar liquidity and stress. The Fed's swap lines are effectively international plumbing. When dollar funding tightens abroad, swap lines relieve it, but swap lines also signal the world still needs the Fed. That can be comforting, and it can be motivating. It comforts because there is a backstop. It motivates because no country wants its credit system dependent on a foreign central bank's emergency tools. The U.S. Treasury manages issuance and auctions. Auction health is not glamorous, but it is critical. Strong bid-to-cover ratios, stable indirect bidder participation, and smooth clearing yields are signs of confidence. Weak demand and rising tail yields are signs of stress. If the Treasury must offer more yield to attract buyers, that affects mortgages, corporate borrowing, and the discount rate used to value assets. It also affects the politics of budgets, because interest expense becomes a first-class variable rather than a footnote. Primary dealers are the shock absorbers. They intermediate between issuance and demand. When dealers' balance sheets are constrained, liquidity worsens. When liquidity worsens, volatility rises. When volatility rises, risk managers cut exposure. That feeds back into currency markets because hedges, margin, and funding are intertwined. Foreign central banks and sovereign wealth funds are the glaciers. They move slowly, but they reshape landscapes. When they diversify, they change the marginal buyer composition. A reserve manager doesn't need to sell everything to move the market. It only needs to buy less at the margin month after month, and the market gradually reprices. Commercial banks respond to regulators. If regulators encourage reducing treasury exposure, banks adjust. They can shorten duration, reduce holdings, or hedge currency risk differently. Those adjustments show up in flows, not speeches. Commodity producers and importers live in the invoicing currency. If they experiment with alternative settlement for even a slice of trade, structural demand for dollars at the margin softens. It doesn't take a revolution. It takes repetition, and repetition becomes habit. And finally, funds and speculators amplify what institutions initiate. They see the correlation break, they press it, and they create the visible volatility that makes people pay attention. They are rarely the source. They are the accelerator. So what is the proof that this is more than a daily wiggle? One piece is the alignment of signals. The dollar weakening while yields remain elevated is not the usual story. Another piece is the scale and persistence of gold buying by official institutions, which is not the behavior of actors fully confident in a single currency reserve future. Another piece is the drift of reserve composition away from the dollar. Another is the narrative shift. When mainstream commentary begins discussing Sell America as a portfolio theme, it usually means portfolio committees have already debated it, modeled it, and begun implementing it in layers. But the most important evidence is the behavior of hedges. In a traditional stress event, the dollar rallies, U.S. Treasuries rally, and risk assets fall. If the dollar weakens and Treasuries do not provide the same stabilizing effect, global portfolios must find new hedges. New hedges cost money. That cost is a hidden tax on leverage, and when leverage becomes more expensive, it changes asset prices, sometimes quickly, because leverage is what made many valuations possible in the first place. That is why this matters beyond the currency chart. The dollar is not just a symbol, it's a discount rate, a funding channel, and a confidence measure wrapped into one. So what does this mean going forward without turning it into a prediction? Historically, when the reserve currency premium declines, three things tend to happen. First, the currency weakens in waves, not in a straight line. There are sharp rallies that punish anyone who assumes the move is one way. Second, real assets tend to hold value better in the currency's terms because the measuring stick is changing. Third, volatility rises because the system is repricing insurance, and insurance is always cheapest right before you need it. From here, there are three broad scenarios the data allows. In the conservative scenario, the crack is contained. The dollar stabilizes, perhaps because growth differentials favor the US, perhaps because risk events elsewhere renew the old reflex, perhaps because policy signals restore confidence. In that case, gold can cool from extreme levels, and the old correlations can partially return. The system continues, but with higher awareness of fragility. In the moderate scenario, the world shifts further toward multipolar reserve behavior. The dollar remains dominant, but the premium declines. That can mean a structurally weaker dollar over time, a higher baseline for commodities priced in dollars, and more frequent episodes where the dollar does not act like a perfect hedge. It also means higher hedging costs for global investors holding US assets, which can influence demand at the margin and make auctions more price sensitive. In the aggressive scenario, an acceleration event occurs. That could be a major holder reducing exposure more quickly, a policy shock that changes settlement expectations, or a funding event that forces rapid rebalancing. In that scenario, moves are faster, volatility is higher, and alternative collateral becomes more valuable. Gold, in that case, is not a fashionable asset. It's a trust barometer. So what should be watched to distinguish a contained crack from a widening one? Watch the relationship between Treasury yields and the dollar. If yields rise and the dollar still weakens, that suggests compensation is rising, but confidence is not. Watch the health of Treasury auctions and the composition of buyers, especially the behavior of indirect bidders that often represent foreign demand. Watch official sector gold purchases and reserve composition trends. Watch the cost of hedging dollars and cross-currency markets, because that is where funding stress shows up before it becomes a headline. Watch whether gold holds strength during periods when yields rise, because that combination is a signal of trust being priced, not just inflation. Now here's the choice ahead, and it's not a choice between fear and optimism. It's a choice between narratives and flows. Most people live in the narrative layer. They hear a story, then interpret prices through the story. Institutions live in the flow layer. They watch who is buying, who is selling, what collateral is accepted, and what funding costs are doing. The gap between those layers is the information gap. Over time, the information gap becomes a wealth gap because the earliest moves are often boring, technical, and easy to ignore. Institutions move first because they have to. A reserve manager cannot wait for consensus. A risk committee cannot wait for a documentary. They adjust exposure when probabilities shift. The public tends to react last, not because of intelligence, but because of access and attention. The data that matters is often hidden inside auctions, basis swaps, and balance sheets, while headlines focus on drama. The dollar cracking is not a single crash. It's the slow erosion of an assumption that the dollar is always the unquestioned neutral center of global finance. When that assumption erodes, the world doesn't stop functioning. It reorganizes. And reorganization is where volatility lives, where correlations break, and where new winners and losers emerge. So if you've sensed that something is changing, but you couldn't name it, this is the name, the market is repricing the idea of safety. The dollar may still be the largest pillar in the system, but pillars can weaken even while buildings remain standing. The question isn't whether the dollar disappears. The question is whether the world continues paying the same premium to hold it. This is macro decode, where we connect what matters before it becomes headlines. If this connected dots you hadn't seen lined up before, you know what to do, or simply stay close to the data. Because the question isn't whether this unfolds. The question is whether you recognize the pattern while it was still quiet.